So what a dramatic week we had.
Quite a
The
week.
markets, yeah, the markets were quite volatile compared from last week, wasn't it?
I mean, it seems like our scenario one from last week's podcast played out. We talked about, well, there were a couple scenarios. One was, a continual downtrend as, we heard more about the tariff situation. And the other one was, well, the market would recover. And here we are, a market recovery.
Yeah, and not only did the market recover,
All-time highs.
Recovered everything. Yeah, it recovered everything within a week, and we're back to all-time highs. And it looks like we're about to break out because I'm looking at the after hours right now,
Right.
and we seem to be breaking out again.
We are. If I look at QQQ, for example, we are definitely at all-time highs today over there, for sure.
Yeah, and I think partly the reason why this is the case is because the worst aspects of the tariffs are essentially over. Like the
Right.
markets are now shrugging it off. We've had the fact that he tariffed everyone basically, so the world hasn't gone to shit because of that. And not only that, the other tariffs like semiconductors, which is pretty damn important for the Nasdaq.
Yeah.
That is not really a tariff because even though it's 100% tariff, everyone's getting exempt. If you promise to produce in the U.S. or you're producing things in the U.S., you are not subject to tariff. Yeah. So
let's do a recap. Let's start over from like where we were at, and where we are now. So last week we talked about the tariffs hit. We had 35% tariff for Canada, tariffs for India, tariffs for basically a lot of the countries. And this week we were expecting either retaliation or more development on the tariff front. Well, we haven't really quite heard anything from all the countries. I think in Canada, for example, it was on the news that Canada has not even spoken to the American government about the tariffs since the deadline. So it was quite a quiet moment in that sense, but we did hear things from the U.S. government.
Yeah. The U.S. government has definitely been making a lot of noise. While they haven't been raising the tariffs from 35% to something else for Canada, they have actually raised tariffs on India from 25% to 50%. Some of that is due to actual trade differences, but also because of the fact that India is importing Russian oil. So Trump has decided to use that as leverage to force them to stop importing Russian oil due to the Ukraine war, through the threat of adding these tariffs. So that's
speaking about the Russian war too. Actually, even I think Trump also did say quite a bit about demands to Ukraine and Russia to stop their conflict too. So that's also been quite active. But I don't think that has quite impacted the market as much as the tariffs. What do you think about that?
Yeah, so I don't think the Ukraine war has much effect on markets anymore because it's been ongoing for 3 years. So markets have already priced the effects of the war 3 years ago when it first started.
Yeah, exactly. And I think also adding more sanctions on Russia hasn't really impacted the U.S. markets too much. Maybe the energy a little bit. Maybe I can take a look at energy. It's just that otherwise it's been pretty quiet on that front. But what did impact the market was the tariffs we're talking about, the semiconductor tariffs and the pharma tariffs. Let's talk about the semiconductors first.
Yeah, so I've already talked about that a bit. It's 100% tariffs on anyone that's producing semiconductors outside from the U.S., but you get exemptions.
100%. That's quite crazy. 100%. When I think we heard the news, we were quite scared, weren't we?
Yeah, we were. We were quite shocked with it, and I think markets were also shocked as well. But when the details came out, I think everyone breathed a sigh of relief and just laughed a little bit, seeing how ridiculous it sounded, right? 100% tariff, but no one actually gets affected. You have the biggest companies like NVDA, AMD, whatnot. They've all promised through their lips that they're gonna produce in the U.S. So that alone gave them the ability to be exempt. I think
that was also probably a catalyst too. I think if you look at the Apple charts, we just see how Apple has skyrocketed. I think obviously their earnings were good, but because of the uncertainty last week, they actually their price ended up going down despite their strong earnings. But we now see today, do we see like a huge candle on Apple that's shooting the Apple price up, and that's because they're promising billions of dollars. Was it 600 billion? I forget the complete total value, but they did promise.
It could be 1 trillion at this point.
Yeah, they what of the promise comes true later is yet to be seen, and I think we remain a bit skeptical about how much of the promise is realized. But I think they did say like was it like $100 billion in the first year would be what they'd be investing into American manufacturing. So
well, to be frank with you, I lost count past the $500 billion promises after 4 years.
Yeah.
So
I completely get that.
Yeah, they've been every company has been kissing the ring. Every country has been kissing the ring.
Mm-hmm.
So I don't realistically think these companies can actually pledge this much capital and actually apply it, because you're basically saying that you're going to find enough workers to absorb all these capital, and you have enough material worth to build up all these factories.
Mm-hmm.
I don't think it's very likely, but it gets to calm Trump down and give him victory points for his voters. And I think that's the most important thing is to basically get him off their backs.
Right.
So the markets don't feel so much anxiety from the looming threats of tariffs.
Speaking about the voters, what were the pressure that he was facing? Do you know what that was about? I'm actually a bit uninformed myself. So what was that about?
So essentially, he is trying to promise his voters, the MAGA base, that he's going to bring companies home and he's going to punish companies who refuse to do that.
Right.
And the best way to create this image that he is winning, quote unquote, is to have these companies proclaim out loud to the world that they're going to, spend hundreds of billions of dollars reinvesting into the U.S.
Okay, I see. Because I think earlier in the first round of tariffs, he already made a pretty early on an exception to semiconductors. And so people were probably wondering, why isn't a giant like NVDA, which is like the number one company in the world now? Is it?
With market cap.
Yeah. With market cap, yeah. And so
about 4 trillion.
4 trillion. And so I think people are wondering, why isn't the biggest company of America, why aren't they being tariffed? Because they're doing all their production out of America. And so that makes sense. That makes sense as to why Trump felt the pressure to do that. And well, it's a good result. I mean, if the promises come true, it's a good thing for American manufacturing. And speaking about materials, I know what I wanted to bring up very quickly, just a quick discussion, is talking about MP. So one of our colleagues at Finquinity, he is quite of a materials guy, a small cap materials guy. And he's been looking at, U.S. rare earth materials, given that we tariff China on rare earth materials. And there's also, an increasing, looks like, promise to invest more in U.S. productions. And so I just want to quickly shout out my colleague and say, hey, he made a great call on materials, and maybe that's a material market is something to look forward to in the coming weeks and months.
Yeah, and not only materials was also looking good, gold has been outperforming this week.
Right.
Gold has been nonstop printing over the last, I think, 2 weeks since last Friday because of the tariff chaos.
Right.
And we've literally moved from 52 to 58 right now. So that's a huge increase from where we first started off. It was chopping and then it just, ripped up.
Right.
Now, I do think that system-wise, the gold is definitely overbought. There should be opportunity for a pullback. But it really does show us that there is still fear in the markets. Despite markets hitting all-time highs, there's fear in the markets because people are building this hedge against Trump, and in case he makes out a tweet, right?
Right.
So in that case, I think that gold is probably a better hedge for risk off than bonds at the moment. Bonds have not been doing so well.
Bonds have not been doing well at all. I mean, to be fair, when we did see the price go down on Friday with the fear of what would the tariff decision look like, the bonds did shoot up, but then very quickly the bonds were squashed down. And I think one of the reasons why they were potentially squashed down is because how bad I want to say the macro kind of has been this week, right? So on Friday we had the job report, and the job reports, well, they told the story of there is quite a underperformance. So unemployment was 4.2%, and then we had non-farm payrolls was 73k, but the expectation was 110k, and so we're in a regime, we're in a place where the fundamentals are kind of bad, but it seems like we're recovering based on the fact that now people are predicting that the September cut is a near guarantee. Whereas before it might have been, a 70, 60, maybe 80% chance. Now it feels like a 90% chance. Do you think the same as well? Do you accept that sentiment?
Yeah, so I think that the market has repriced those cuts in, and it's all but guaranteed, provided that we have, crappy data again for August, that the September cut is in. And the reason is quite simple. It's because the labor market has severely weakened, and there were downward revisions of employment data of over 250,000 jobs in the over the last 2 months before the report that we had this week and last week. So, you're essentially saying that you've overcounted 250,000 positions, right? That's a 250,000, and it's quite bearish, frankly speaking.
Right.
And it indicates that companies are either not hiring anymore because of tariff uncertainties, regulatory uncertainties, or the interest rates that the Fed has, raised over the last couple of years, it's finally, biting onto the labor market, and it's causing the Fed to reconsider whether or not they should pause or they should begin cutting again.
I mean, to be fair, the pause was entirely due to, geopolitics, where it was very largely affected by geopolitics. But I think as we're seeing the impact it's having on the labor market, it seems like at this point it's a necessity. So I think that's why it's being priced back in, and we're seeing a week where that's driven by the optimism of further the rate cut, and also the optimism that is coming from more certainty in the market, because since last week there was quite of uncertainty of what was going to happen with regarding the whole geopolitics, the tariffs, and how people and country will respond. And a lot of the fears have been quelled. There are still some outstanding fears, but it definitely does feel a bit more, like a lot more secure than we left off last Friday with.
Yeah, I agree. I feel much more bullish this week than last week, absolutely. And just taking a look at Bitcoin's price action, Bitcoin has also, recovered from the lows. If you check it on our system, it bounced quite immediately from the
rally
blue
zone.
region,
the
rally zone, right? And we've already breached the KRM line. So at this point, it's a matter of going back to the overbought zone. And I'm quite confident that just based on the risk sentiment with QQQ and with the overall markets, that it's a matter of time. It's not if, but when.
Yeah, and people have been expecting, I think, 120 for the August target. So let's see how it holds up. I mean, at the moment, things seem to be geared towards it. What do you think are going to be driving, next week's factors for, the Nasdaq, the S&P 500, and Bitcoin? I mean, if I take a look at the data, let's look at the data for next week. Data next week, we get more inflation data, and some PPI data, as well as retail sales. I mean, I feel like the story is going to be, we're going to see high inflation, we're going to see, less sales, and I feel like that's going to be the trend.
Yeah. what I'm looking at, what I'm more concerned about,
Right.
I'm just looking at the calendar. Just pull it up next week. So, okay, yes, 11. Right. So we have the core CPI. So we'll see how that's going. Core PPI, initial jobless claims. I think those are the most important data. They will basically cement the rate cut percentages. Nothing else I think matters at that point.
Right.
Already, as we're speaking, the markets have already expected the rate cut. I think that if the CPI data is too hot, it might actually be bearish for the markets.
So for sure,
we have to gauge whether or not it's going to keep going up. We're looking at the median forecast, and it's 2.8, which is quite hot already.
I agree.
So if you continually beat that estimate, you don't have a lot of room. Like I think the magic number is 3.0. If you break that handle, the psychological handle, people will start getting nervous.
I think 3.0 is a really good handle. I think 2.9 should be fine. 2.8 I think is the expected. So let's see where that goes. I think you're right. 3 would probably be a scary place to be, and that'll probably be the most immediate impact on the market, because because the cuts will still be a while away. And
that's right.
But about the cuts, how much are you expecting them to cut this cycle? Is it a 0.25, 0.5? What are you?
So the implied rates right now is 2 cuts this year. Each cut is 25 basis points.
Right.
So essentially, you'll get a cut of 0.25% in September, and then I think another cut in October. I think it's October. So those 2 cuts are basically what's predicted. And the market is swinging between 2 cuts to 1.5 cut. Which is kind of ridiculous, right? But that basically what they're saying is that there's a cut in September, but they're 50-50 on the October cut. That's what they're essentially saying.
Okay.
Yeah. So I think that cuts are quite appropriate given the fact that the labor market is not doing so well right now. It's definitely cooling down. The Fed has made comments on that, but it will also depend on whether or not the tariffs continually cause inflation on those goods that are being imported, because these companies are dealing with tariffs that are changing week to week, so it's quite chaotic. You have products, you have products that are tariffed at a certain rate, at 20%, but then their next batch of product is at like 40%, and then it goes back down. So if you consider the cost in creating all this accounting and figuring out what the actual cost is and how you can price that into your consumers, it'd be quite difficult for small businesses. Not to mention the fact that the government has to, expand their staff so that when they're checking for these imported products, they're actually tariffing these products at the rate that they are, right? Because if you have a car, for example, that's being imported, made from different parts of different countries, I don't know how you can really slap a one number tariff on those parts.
Oh my god, can you imagine what it's like to be a manufacturer? I mean, I feel like it's quite tough for them. It's quite tough for them.
It would be quite brutal, yeah. So as a result, I can definitely see more price hikes happening because companies have so much friction they have to deal with. Yeah. And I would not be surprised if the CPI data breaches the 3.0 handle. So
alrighty.
I'm quite interested in seeing what that number will be.
I feel like I don't expect it to reach 30%, but it would be quite interesting to see it reach it so early. I think what people are forecasting is Q3, Q4 is when like the impacts would be felt like at that moment. But I think the tariffs, like a lot of tariffs agreements, they happen in like Q2 most of the time, and so like the impacts are always going to be like 6 months delayed because there's already like existing orders which cannot be changed in pricing, and there are already like existing inventory. So I think most of the effects will be seen in Q3, Q4. So I'm really very curious to see what happens. And I think we said in the short term, I think sentiment is quite good, but the more medium to longer term, I feel like we still are in a very uncertain environment. And I know we don't want to talk about politics too much, but in this Trump presidency, it's been quite an uncertain ride. And I think one thing we're just discussing is moving forward. Well, we might want to be positioned for risk on, but we're also looking to find a stable hedge, um, in case there is uncertainties that can happen due to geopolitics or otherwise, with most likely Trump being at the driving factor. I think one thing we said was gold. Are you looking at anything else to hedge your bets?
I think anything that has domestic production, like MP, for example, MP has been flying, so I don't know if we can encourage people to get in on that.
Mm-hmm.
But gold is a solid hedge because traditionally speaking, when bonds are doing so hot, it's because people are pivoting the gold as a storage of value.
Right. What do you think about healthcare? Do you think healthcare is a pivot? I'm not too well informed in the field.
Healthcare has been weird because if you look at XLV, XLV has not been doing so hot because it's just been shopping over the entire presidency, and it's actually in bearish market. So the reason why is because of regulatory uncertainty. A lot of the medications and a lot of pharmaceutical companies has outsourced the production from the US, and now with these tariffs of going to a 250% over 18 months.
Oh yeah, never mind. You're right.
It's quite uncertain because now you have 18 months where these companies have to figure out how they're going to talk with Trump to get these tariffs removed or gain exemptions. Right. And unfortunately for these pharmaceutical companies, a lot of these drugs are produced in countries that have been the ire of the Trump administration, especially India and China, for example, because that's where drug production costs are very, very low.
One thing I'm interested to look at, what would be the impact on insurance? I feel like insurance premiums are probably bound to rise, just based on that factor alone. So I'm quite curious to see how that would go. I mean, utilities have been doing really well too. I mean, maybe not last week in particular, but utilities have been doing quite well in this time, because I think obviously utilities will continue to go up, and the macro is looking too good because people have to obviously spend in utilities. They can't really avoid that. So utilities has been good. Are you thinking of utility as a hedge, or do you're not a fan of?
Yeah, so I think XLU is a really great hedge for risk. I noticed that on Friday, when the market was crapping the bed, XLU did not do so bad. I think it was like almost flat, relatively speaking. Relatively flat. So because of that, I've been observing it, and I think that XLU could be a really good pivot point when we are able to sniff out risk-off sentiments. Like, for example, Bitcoin was actually hitting the lows before the Nasdaq did.
Right.
And when that happened, we sensed the fact that, hey, I think risk-off is going to come soon. So if we pivoted to XLU or its leveraged version, UTXL, we've been able to avoid the drawdown and also be able to earn more alpha compared to the SPX.
Right. Yeah. XLU has been a pretty good bet. I think the last thing we'll say, like the last recommendation that we'll make before we probably sign off for today, will be TFLO. This is a treasury fund. This treasury fund it keeps the price pretty stable between 50.4 to 50.6, and at the moment their annual yield seems to be around 4.48%. So they're doing a pretty good job with just having your money there. So if you have cash you want to keep parked, it might just be a pretty good place to keep your cash. I think we'll probably say that about hedging your bets. Is there anything else you want to add for this week's podcast?
I think that's basically it.
Yeah. But I think before we sign off, let's do maybe like a quick take about where we are for next week's sentiment. And I think I feel like I'm leaning towards cautiously optimistic. Obviously, we're going to be looking at the data coming in, but it seems like we're positioned already, just doing the overnight markets, to keep the momentum going, keep the bullish momentum that was happening before last week. Keep going.
Yeah, I'm also cautiously bullish as well. I think we can break all-time highs because we flushed out all the paper hands. So
Friday was a paper hand moment, wasn't it?
Yeah, exactly. So it was, just a matter of flushing them out. Now that we've kind of consolidated, I can see the QQ is breaking all-time highs at a sustainable level without having any fades right now.
Mm-hmm.
But we'll see what happens on Monday and whether or not the CPI data is favorable to the markets.
Yeah, and obviously keep an eye on the news. In this day and age, the news dictates the market more than technicals might. So always keep an eye on that.
Exactly. And I think we can wrap it up here.
Yeah. Well, thank you so much for watching. I hope you found this very informative, entertaining, and educational. Thank you for your support. Subscribe.